If you've ever wondered when can I stop working or how do I build freedom with money, you're in the right place. Because in today's video, I'm talking about how you can retire early using my favorite way to invest, low cost index funds. Unfortunately, most people can't be asked with education, haven't got the discipline for long-term investing and won't retire early, if at all. But I've got a feeling that isn't you. Now, I've been investing for 24 years and over the last 6 years, I've built 6 figures in 3 separate asset classes after really focusing on financial education. And I'm going to use all that experience to help you invest into assets, build wealth, and potentially retire early. Chapter 1, why retire early is even on the table. First, what does retire early actually mean? In the FIRE movement world, it often means reaching financial independence, so you no longer have to work. For a UK audience, this might mean continuing some income streams, but not being dependent on a 9-to-5 job. A key number, you'll often hear of the 25 times expense rule. If you withdraw 4% a year, your invested pot needs to be about 25x your annual costs. For more on the 4% rule, see below for a recent video. The good news, with discipline, saving and index fund investing and time on your side, it can become realistic. But mindset matters. You'll need to focus on savings rate, expenses, avoiding bad debt and long-term discipline. Pause the video now and in the comments type, my annual expenses are X amount. Knowing that number is your first step. By the way, if you are serious about investing and early retirement, hit subscribe so we can build wealth together. Chapter 2, why index funds make sense. What is an index fund? Simply put, it's a fund which tracks a hallmark index, like the S&P 500 over in the US or the FTSE 100 here in the UK. So you buy the market rather than trying to pick winners. Why this matters? Research by Vanguard shows that low-cost, broadly diversified index funds have outperformed most active managers over the long term. Thanks to lower fees, few mistakes, and the zero-sum game nature of markets, for a UK investor, you get benefits like simplicity, low cost, diversification, and fewer temptations to trade or chase hot stocks or crypto. Key point, time is your friend. The earlier you start, the more the compounding works for you. And again, if you see below in the description, you'll find a recent video that fully explains compound interest. It's important. According to Fidelity International, some of the cheapest index fund options in the UK have ongoing charges of just 0.07% or 0.1%. Basically, if you invest 10,000 at 0.07%, the difference becomes meaningful. As always, nothing in this video should be taken as financial advice. And the full disclaimer can be found below in the description. Chapter 3, the UK specific toolkit. Since I'm focusing on UK investors for this video and playlist, I'm going to talk about the UK vehicles and how you can build your early retirement plan. But this info can be applied to most countries where investing is accessible. Stocks and shares ISA, tax efficient wrapper where gains and dividends grow free of UK capital gains tax. SIP, self-invested personal pension, excellent for long-term saving, gets tax relief. Note, some access, age restrictions, 55 now, rising to 57. Use any of these account types to invest in index funds. Choose low-cost index funds or ETFs from strong providers, Vanguard, iShares, etc., etc. For example, iShares Core FTSE 100, 0.07%, Vanguard S&P 500, 0.07%. Diversification. Don't just invest UK shares, global equities matter and will probably perform better at this moment in time. Use the set and forget approach, which is regular contributions, monthly or quarterly, automatic rebalancing, minimal intervention. If you build an early retirement, aim for a high savings rate. Many FIRE practitioners save 40 to 70% or more of income. That means living well below your means. Aggressively saving, invest in the rest. That isn't realistic for most people, and I would try and start with 10% of your income, which is normally recommended when you read the best investing books. If any of this info resonates and you want to start investing in the near future, type yes below and you can have a PDF copy of my index investing cheat sheet that walks you through the process and is something you can refer back to as you start making regular investments. Chapter 4, how to build the plan step by step. Here's a 5-step process you can follow to use index funds for early retirement. 1, define your target. Work out your annual expenses in today's money. Say you want 30,000 a year, multiplied by 25 for the 4% rule. This equals 750k. That's your rough pot target. This isn't adjusted for inflation, as I prefer to keep things simple. Note, some argue a more conservative withdrawal rate of 3%. This might be safer if retiring early. You can make your own mind up as you become more financially literate over the years. 2, set your investing rate. The bigger the investing rate, income minus expenses, the faster you hit your target. For UK, use both ISA and SIP. Also maximise workplace pension contributions if this applies to your situation. 3, choose your index fund portfolio. Simple portfolio, 80% global equities via a low-cost index fund plus 20% global bonds for diversification. Adjust according to your risk tolerance and how many years you have until your target. For example, global equity index fund via Vanguard or iShares. 4, automate and stay consistent. Set up monthly contributions. Ignore the noise. Markets will go up, down, sideways. The secret is consistency plus time. Rebalance every year if you're comfortable to maintain your asset allocation. 5, plan your exit strategy. When you reach your pot target, how will you draw down? Options, leave funds invested, draw a safe percentage each year, use ISAs for tax efficiency, prepare for sequence of returns risk, which is early withdrawals when the market is down. Having a cash buffer helps, by the way. Chapter 5, mindset. It's a marathon, not a sprint. The retire early could still mean your 40s or 50s, depending on your income, savings rate, and how aggressive you choose. Pitfalls. Chasing hot funds or stocks instead of sticking to a low-cost index strategy. High fees. These erode returns over the decades. Failing to plan for tax, inflation, and changes in lifestyle. Ignoring account wrappers. Tax-efficient accounts. Emotionally panicking when markets drop. Stay the course. Keep investing. And when you think long-term, it removes the stress. My first 18 years as an investor was very up and down. In fact, I was a rubbish investor and made far too many mistakes, like losing our life savings, gambling in the stock market in 2011. Basically, I was listening to the lads at work and I had no idea what I was doing. Things have changed for me as an investor over the last 6 years, and it's mainly down to financial education and a big change in mindset, like the fact that I have the discipline to invest long term. And I know from experience, chasing quick, easy money just doesn't work. Chapter 6, real example and numbers. Let's walk through a simple example. Imagine you're 35, expenses of 30k per year, and you decide to save £1,000 per month into index funds. Assume average annual return of 10%. Just as an illustration, over 20 years, your contributions plus compounding would potentially get you to 750k, allowing you to consider early retirement at 55. Again, these numbers are illustrations only. Actual returns can vary. You could get back less than invested. Always tailor to your situation. When I say 10% returns, on average, it's based on historical data. Chapter 7, what to do right now. Here are your next steps after watching this quick 10-minute video. Open any missing tax-efficient accounts if you don't already have one. ISA and or SIP, choose a low-cost global equity index fund and maybe bond fund. That fits your risk tolerance. If you want some options, look at the what to buy video, which is part of this playlist. Set up automatic monthly contributions. Keep track of your annual expenses. Revisit once a year. Write down your why you want to retire early. This will keep you motivated when the markets wobble a bit. Personally, I want to live life on my own terms. I want financial freedom so I can spend more time with the people I love, doing what I love. If you found this valuable, hit the like button, subscribe, and share this video with a friend who's also chasing financial freedom. And comment below, what age do you want to retire? I reply to as many comments as I can. Summary. Thanks for watching, and try and remember, retiring early isn't about a magic stock pick or chasing the next big thing. It's about consistency, simplicity and time, using low-cost index funds and the powerful benefits of compounding. You've got the plan, now it's time to execute. Try where possible to stay invested, stay patient, and I'll see you in the next video. That's the end of this playlist. If you need more help and support, you can join my free investor community on School. There you're surrounding yourself with hundreds of like-minded investors, and you can get one-to-one support from me. All you've got to do is look in the description.